So good morning, good afternoon, and good evening around the world. Thank you for attending this really important and informative session on international tax. My name is Doug Brunke. I'm the CEO and founder of Global Chamber, and I wish 20, 30 years ago when I was right in the heart of doing exporting that I had a global chamber because we get to talk to amazing people. And today we're talking to Dean Morris, who happens to be today in London, Ontario, but works for Trowbridge out of Toronto, and Christopher Klug of CKR Law, who is based in the Washington, D.C. area. And these are two preeminent experts on international tax, and they've got two really interesting main topics, and there'll be a variety of others. And so what we encourage you to do is listen during their presentation, and then as you have questions, there's an area there in your Zoom box for a chat or for Q&A, and please enter your questions there, and we'll get to them in the second half of our program, and they'll be able to answer them live on the air. So first, we're going to go to Dean. Dean, you're the Senior Transfer Pricing Advisor at Trowbridge. You're originally an economist. You've got greater than 20 years experience in transfer pricing. And so you are, as far as I know, the preeminent world expert. So thank you very much for sharing your information today, and we look forward to hearing more.
Great. Thank you, Doug. So this morning, what I'm going to be talking about is the most recent developments of transfer pricing in Canada, and that was resulted from the 2019 federal budget that was released just a little over a month ago. And what I'm going to be doing is there's two transfer pricing proposals. Deal with those, just kind of define what those proposals are. What is that? What's the implication to Canadian taxpayers of those two proposals once they make it into the legislation? And then conclude with a couple scenarios on showing some of the risks with respect to the transfer pricing and where do these proposals fall in the context of the grander scheme of things. For anybody that's listening that's maybe new to transfer pricing or just kind of unfamiliar with transfer pricing, the budget did give a kind of a nice, tidy definition of what transfer pricing is. So essentially, transfer pricing is really relating to the terms, conditions, the price of transactions that occur between that occur across international borders by people who are not dealing with at arm's length, or definitely the corporations that are not dealing at arm's length, either a parent or subsidiary company or sister companies. And these transactions involve the products of goods, services, and tangibles, and also some financing transactions, and such as loan guarantees. Okay, the two transfer pricing proposals is the first one is the ordering rule, and what the ordering rule is that in the event of a transfer pricing reassessment or reassessment by the Canadian Revenue Agency, sometimes an auditor may be more familiar or comfortable with other parts of the Canadian Income Tax Act than some of the transfer pricing, and they may reassess based on other parts of the Act that deal with fair market for certain transactions instead of the transfer pricing where it could also apply. So the ordering rule is that if transfer pricing were to apply, that it takes precedence over these other income tax adjustments that may occur. The second transfer pricing proposal is to use a single definition for all the transfer pricing rules, and this single definition is definitely more broad and more encompassing than it has been in one other part of the Income Tax Act. So the next, the implications of the ordering rule is that when you have buckets of reassessments that haven't been considered a transfer pricing adjustment that's then put into the, what we call the bucket of transfer pricing a reassessment, then it does have an upward pressure on any potential transfer pricing penalties. And in Canada and as well as the US and a lot of other areas, a lot of other countries, there's often two conditions for a transfer pricing penalty to apply. One of the ones is if it's the reassessments reaches a certain threshold where a penalty would be applicable. And the other one is that if the company that has received the reassessment has not demonstrated that they have shown a reasonable effort in determining or maintaining their transfer pricing policies. And in both Canada and the US, this is often referred to as your contemporaneous documentation, which is a bit of an irony because the documentation that you have to provide is really looking at and justifying why your transactions with your related party follow the arm's length principle. So had you done that work, your risk of reassessment would have gone down anyways. So this is really giving the incentive to taxpayers to put the effort on maintaining their transfer pricing policies and to be able to communicate either through the U.S. regulatory requirements or the Canadian legislative requirements on demonstrating that they've made a reasonable efforts to do the transfer pricing terms and conditions appropriately. Now, as this ordering rule increases the risk of the transfer pricing reassessment and also potential penalties, there's also a secondary adjustment which occurs in circumstances where, as an example, you have a U.S. parent in a Canadian subsidiary. If the Canadian gets a significant reassessment, then the Canada Revenue Agency will deem that amount to be a dividend that Canada had paid to the U.S. And their logic is that the U.S. has that money, has paid tax on that, so it's as if Canada had paid the dividend if the transfer pricing was appropriate. And so as this transfer pricing reassessment increases, the withholding tax on this deemed dividend would also have an increasing impact. And if the U.S. repatriates the reassessment back to Canada, then you can often eliminate that withholding tax when dealing with the CRA, the Canada Revenue Agency. The implications of the transaction definition, this is a bit more limited in scope, and the Trowbridge clients, I don't believe this really would impact any of our client base. It's kind of more of a limited implication. And what this does is that when a Canada Revenue Agency is auditing a transaction, typically when they audit a corporation, it's for 4 years that they can look at. And if it's an international transaction, they can increase that by 3 years to 7 years. And the definition of that the Canada Revenue Agency use when they determine if it goes from up to 7 years has been more limited in the past. So they're now going to include a more broader definition that would include the terms arrangement or event. And when this would occur is if you have a related party transaction and some more complex structures, there is a third party put in the middle. And when this third party is in the middle, in cases where the risk, the scope is very limited compared to the two related parties, then the CRA will deal with that, would look at that as if it's a related party transaction and kind of looking at as the whole arrangement or event. So that in those cases, they would then be able to go up to 7 years. Now, for when it typically, they only look at 6 years when it's a Canada-US transaction because of the Canada-US treaty, unless certain years are still remained open, that they've notified both the US and Canada competent authorities that there is going to be a reassessment that's going over the 6 years, which typically is covered under the treaty. Okay, the next slide here is I'm just kind of going over some specific numbers and to give some examples of the penalty risk. And if the penalty risk increases because of either of these proposals, it kind of gives some context of where, what size of transactions would you need to be concerned about. And it's an interesting exercise because more often than not, the penalty risk of our clients isn't that significant. And I say that because it's in order to reach the penalty threshold, if it's a small multinational or even a mid-market client, that in order the degree that they have to be off for the penalty to kick in is quite large, except in cases where you have an entity that's most of their business is with a related party. Then it's often easier to hit these thresholds. And there's other risks, that just the main transfer pricing risk, the audit risk, just looking at the relative profitability. If it's in Canada, the US now has a lower tax rate than Canada. So is there certain situations where the profit in Canada can be argued that it's can be shifted to the U.S. within the scheme of things, or if that's the case, then is there certain functions, certain risks that they can move to the U.S. that they were considering in the past, that now is a good time to do so. But under the first scenario here, we have a Canadian company with $1 million worth of revenue and $500,000 worth of related party transactions. And these related party transactions consist of goods, services, and intangibles. And this chart on your slide here, the top line shows the reassessment amount, and the row under the Canada penalty, when the Canada Revenue Agency reassesses the amount, this is the penalty that would result for these amounts. So if it's a $250,000 reassessment, then it's 10%. And in Canada, it's always 10% of the reassessment. And we can see here the threshold is the $100,000. So as soon as it goes below $100,000, then there's no penalty in Canada. In the US scenario 2, similar situation, except it's the IRS that's reassessing $1 million of revenue in the US. And the US has two different penalties. One is large penalty and the other one's huge, I guess. It's kind of the different sizes of the penalties. If it's a $250,000 reassessment, the larger penalty would apply. And then if it's $100,000, the lower one would apply. And then below 100,000, just as in Canada, in this scenario, it's that threshold is equal. A couple of differences between the Canada-US penalties. The US is based off of taxable income, where the Canadian penalty is based off of the size of the reassessment. If the US is in a loss position, then there's no penalty because there would have no taxable payable. These numbers here, I've used a 35% tax rate because when we're auditing, we're dealing with the past. Those numbers will drop with the lower US tax rate going forward. Another couple interesting differences is that Canada's penalty, it's not tax deductible, where in the US it is a tax deduction. There's interest on the penalties in Canada, and I'm not sure, but I don't believe there are interest on the US penalty. Next slide. Very similar scenario, except this time the numbers are larger, and I've given a difference in revenue between the Canadian company and the US company. Here, the Canadian company has $50 million worth of revenue, and we're dealing with a $10 million related party worth of transactions, so about 20% of the revenue. Under the table at the bottom of the slide here, we kind of go from 6 million down to 5 million down to 4 million for the different reassessments. Canada, again, is 10% of the reassessment all the way across. And here the threshold for Canada is $5 million going down to zero with anything less than $5 million. Scenario 2, I've got the US only at $20 million. Scenario 1, it was the $50 million, so the US is $20 million. And we can see here that it's only the large penalty that would kick in for the US because of the way the penalty is calculated. So in this case, the penalty in the US is larger all the way across, and then have different thresholds with the different revenue amounts. And it's interesting, this scenario, because when you often in the case where you have or not often the case, but some typical cases where you have, say, a Canadian parent and a US subsidiary that has grown very well over the years. And when it was in the startup and the early development phases, that we're kind of generous on the transfer pricing. And when I say generous, is that maybe there's certain charges or certain costs that should have been allocated that kind of as a company, you're reluctant to allocate until it gets developed, but then you get into a habit of not charging what you should be charging as compared to as you would if it was with a third party. And this is a case where perhaps you weren't charging enough for intangibles or services. When the revenue grows up to quite a large, then the penalty risk can kind of sneak up on you in this type of scenario. So that's kind of an interesting way of looking at that. So to sum everything up, and yeah, you can go to the last slide now, Cesar. To sum it up, the proposals directly don't have a huge increase in transfer pricing risk in Canada for a lot of clients. It's often, or a lot of companies, often the odd company this would impact more. It does increase the risk indirectly for two reasons. One is because of the ordering rule, the transfer pricing is always going to be more on the top of the minds of the CRA, Canada Revenue Agency auditors, when they do audit these transactions. The second aspect is this budget. It's the fourth consecutive budget where the Canadian government has increased funding to the Canada Revenue Agency, either for development and improvement in their systems, which is kind of long overdue in a couple areas, and as well as increased of staffing. And for more, definitely on the corporate side, there's more staffing that do look at audit and auditing these companies. And so that's kind of where it goes in the scheme of things. And so it is something that, to keep in mind going forward is what is the transfer pricing risk? Is there some certain penalty risks? And is this something that we really want to address or need to address sooner than later? Okay, thank you.
Very good, thank you, Dean. We have some questions coming in, and so as you have other questions, please send them in. We're now going to go to Chris Klug in Washington, D.C. Chris is a partner at the Tax Group, also a private client and wealth preservation group at CKR Law. He has been an advisor on U.S. taxation of foreign entities and foreign corporations, and he's going to be talking to us about some maybe a little bit more general, but also some specific international tax topics we should all know. Chris, thank you for sharing today.
Yeah, thank you for the introduction, Doug, and appreciate the opportunity to talk to everyone. This is going to be kind of a broad overview of non-U.S. companies, which I'll refer to as foreign companies, looking to enter the U.S. and the various considerations. To start, I like to look at what is it that the company, or I guess it could be a foreign individual, what kind of business are they looking to do in the U.S.? Are they, looking to start a factory? Are they looking to sell goods from outside the U.S. to U.S. customers? And then it's always important to kind of consider, if your end goal is to take the money back out of the U.S., what's the best way to minimize tax both during operation stage and when the company exits the U.S. And there's some great opportunities based on the U.S. tax rules for foreign companies to structure their U.S. kind of operations to minimize tax, and it's kind of an advantage in a lot of cases as to U.S. companies. So to start, what is the footprint that really the foreign company wants to do? Are they looking simply to sell goods into the U.S., or are they looking to set up a physical presence in the U.S.? That's going to really make a determination of whether U.S. tax is going to apply to the transactions that occur. Another important fact is you have to worry about state income taxation. So not just state income taxation, but also sales tax. So is there enough nexus to a state for the state to tax what's going on. And then you look at U.S. tax treaties, bilateral agreements with other countries to see if there's any tax benefits that apply under the treaty as to the operations, maybe a reduction in taxation. If there's going to be actual business in the U.S., I typically like to set up a U.S. entity, whether it's disregarded for U.S. tax purposes, or if it's a U.S. corporate type entity, in order to more definitively separate foreign operations from U.S. operations. It also provides another level of liability protection. And then if you're going to need to, the U.S. tax rules has classify foreign entities as either partnerships, disregarded entities, or corporations. And that's going to play a part, again, into what the initial taxation will be of a foreign entity that's looking to come to the U.S. and whether you want to make some kind of election to change that status. And finally, if it's an individual, foreign individual, there's other important considerations as far as their investment in the U.S. because there's we won't get too much into estate and gift tax, but foreigner only has no U.S. gift tax exemption and 60,000 estate tax exemption. So if you're doing real estate investment, you'll jump right over that level and be subject to estate and gift tax when transfers are made or there's a death. So start with, will the company simply kind of remotely be selling goods into the U.S.? And if so, are they doing it through kind of a related party seller like Amazon? Or is the company looking to use agents? So they're not going to have a physical presence in the U.S., but they're going to hire a company to go around and try to sell their goods or whatever their product might be. Or is the foreign entity looking to have a fixed place of business in the U.S.? And what's the extent of the activities in the U.S.? And these questions will all kind of determine to the extent U.S. federal and state income tax will apply to the operations. And so there's two main ways that the U.S. taxes both foreign companies and individuals. And the first one is when you have an active trade or business in the U.S., if it has effectively connected income, then it's going to be subject to U.S. tax under normal U.S. tax rules to a U.S.-based corporation or U.S. individuals. Under these rules, the key is that it's on a net basis and taxed at graduated rates. The corporate tax is now a flat 21%, but the key with the net basis is that you can take deductions, tax credits, so you get to subtract out amounts for expenses and then just be taxed on what the actual net income is. The other way, more passive type income, you can maybe think of a brokerage account that a foreigner owns, and it has U.S.-based stocks and there's dividends that are issued. That income is going to be taxed at a flat rate, and the flat rate by statute is 30%. And the agent, which here would be the brokerage company, has to withhold the tax from the dividend distribution. The thought process is there's not much of a connection if you're living maybe in Greece for that Greece person to be incentivized to file a U.S. tax return just to report a little bit of dividend income. So they do withholding at source. The tax can be modified by U.S. bilateral income tax treaties. So the effectively connected income standard moves to a permanent establishment test under a U.S. tax treaty. And then a lot of times the passive type income that's U.S. sourced, called FDAP, that the withholding rates are reduced. So instead of 30%, a lot of times the withholding rates will be reduced to 10 or 15%, and for certain types of income can be 0%. Next slide. So one of the reasons that effectively connected income is not subject to tax on the gross amount is they think that if a company's here doing business, there's enough connection to the U.S. that they're going to file a U.S.-based tax return. Maybe likely there's more assets they can seize if the taxes aren't paid. And for the FDAP passive type income, the foreign person really has no physical connection to the U.S. So that's really the reason for the withholding tax requirement. And for the withholding tax or any of this, a foreign person a lot of times will be asked to supply was called a W-8 Ben or W-8 Ben-E for corporations. And this allows the companies, one, to certify, the foreign persons to certify that they're non-US, and two, to make claim treaty benefits for reduced withholdings on the tax. So then on the next slide, big to kind of determining what's going to be subject to tax in the US are the sourcing rules and how income's actually sourced. So just some of the income, and this is usually FDAP type income where it becomes an issue. Any income that's effectively connected to a US trade or business is subject to US tax, whether it's capital gains or whatever type of income it might be. Interest income is sourced to where the payer's residence is. However, if the payer's residence is in the US and it's a foreign company, there's something called the portfolio exemption, and that really covers most interest income. So a lot of times interest income is not subject to US taxation when a foreigner holds it. It just has to be in what's called registered form. Now there's related party rules specifically for kind of to stop some of the transfer pricing possible opportunities, where if a related foreign corporation loans money to the US company and they try to get profits out through interest that's not subject to tax in the US under the portfolio exemption, that this rule says now if the foreign corporation owns more than 10%, then it's going to be subject to US tax. The flip side of interest income is the ability of the US company to actually be able to deduct the interest payment to the foreign company, and there's also limitations on that. Dividends is sourced to the payer's place of incorporation. This is going to become important in determining how you want to repatriate income back to the U.S. for the out of the U.S. back to the home country. So dividend income will be subject to U.S.-based tax, but for the most part, capital gains is not subject to U.S. tax. The one exception is U.S. real property interest. For a while, there was no rule, and a non-U.S. person could own U.S. real property interest and sell it and recognize no taxable gain. That would seem to be quite the advantage. Now, kind of the big play between the dividends and the capital gains is that if you liquidate a company, a U.S. corporation, and you're a foreign owner, that capital gains, liquidation creates a capital gains, that's not subject to U.S. tax. Rents and royalties are sourced based on the place of use of the asset. This is important kind of for e-commerce and maybe licensing of computer software. So where that software is going to be sourced, the sale of it is going to be where that software is downloaded on the computer. And that, I think there's a lot of non-compliance, but that could, if you're selling it, let's use Greece again, computer software from Greece to a US customer who downloads it on their computer, then that should be subject to US withholding tax. Then personal services are going to be sourced based on where the services are performed. Let's see. All right, so there's really no great, the Internal Revenue Code doesn't have a specific definition of what is a trade or business for purposes of income effectively connected to a U.S. trade or businesses. The general rule that's developed is profit-oriented activities carried on in the U.S., which are regular, substantial, and continuous, are properly classified as a trade or business. So typically, as a tax person, you get a lot of gray areas like this, but they try not to do bright line rules because it makes it too easy to get around them. Activities of an agent for purposes of this test are typically imputed to the foreign company. So if you have an agent full-time in the US going around promoting the product, selling the product, that could create a US trade or business. Whereas isolated sporadic transactions will not usually create the connection, and so there would be no US federal taxation. And passive investment activity is not going to create a US trade or business. One important point is rental activity typically falls into the passive category. And why that's important, passive rental activity would be subject to US tax at a gross 30%. So there's no deductions for expenses. So let's say there's rental income of $100 and expenses of $90. If it's effectively connected to a US trade or business, there's only $10 of income to tax because it's taxed on net income. But if it's considered passive income, which is typically a default for rental activity, it's that $100 is going to be subject to a 30% tax at $30. And even though there's $90 of expenses, you still owe $30 in tax, so you lost money. So there's a rule where you can make an election to have rental income treated as effectively connected to a U.S. trade or business, and that allows you to the rental income be taxed on a net basis. All right, some important points as far as an effectively connected income. If someone comes to the U.S., and sometimes this happens with board members, foreigners who are board members of a U.S. corporation, or they're on a short-term assignment in the U.S., typically that's going to be U.S. sourced income. The question is it taxable in the U.S.? By statute, they give a very limited exception, which is if the services were performed in 90 days or less, and the income attributed to the services are $3,000 or less, then there's no U.S. tax on that income. However, that gets exceeded pretty easily. Under treaties, they typically change that rule to a certain degree. The one treaty I've looked at, I believe it was 183 days you could be in the U.S., and there was no cap on the income that could be earned for it to be excluded from U.S. income. Foreign partners of a partnership their income will be effectively connected to the trade of business of the partnership itself. And then gain from the disposition of real property interests has its own regime. It's called FIRPTA for short, but the Foreign Investment in Real Property Tax Act. And that was to get around that issue where foreigners could sell U.S. property and recognize no gain. And this has a withholding regime. So again, if this person sold the property or a company and they're outside the U.S., what's the incentive to make them file a U.S. tax return? So at the time of sale, there's a gross withholding of 15% federal tax of the sales price, which can typically be a large amount. Now, in order to get a refund of anything of that withholding that's taxed above the actual gain that's recognized, then the foreigner will file a U.S. tax return and get the tax. There's also some ways to get exemption letters ahead of time if there's no gain, but that deals with the IRS and going through. Not that it's a difficult process, it just takes time. And if real estate, once someone decides to sell, a lot of times the closing happens within 30 days or so. So waiting on the IRS to get you a letter that you need for 90 plus days is not always feasible. So the treaty requirement overrides the effectively connective income requirement. And so in treaties, they require a permanent establishment in the U.S. for there to be U.S. income tax on the business activity. And so this is a little more of a presence requirement test. Typically, there's going to be a fixed place of business carried on by the company. And inside that, even if there is a fixed place of business, the treaty allows for certain additional activity, for example, maintenance of a fixed place of business for purchasing goods and merchandise, and or collecting information. Agents, again, they modify the typical rule. And for agents, the agent has to have the ability to conclude and bind the enterprise to contracts in the U.S. for it to be attributed as a permanent establishment in the U.S. And so another big issue in the U.S. is the branch profits tax. And just as a background, a U.S.-based C corporation or just a U.S.-based corporation is subject to 2 levels of tax. First level at the operations, so the corporate, there's an entity level tax. Then when the earnings are distributed out to the shareholders, there's a dividend taxation. And a lot of times smaller to mid-sized businesses choose not to have a corporate form in the U.S. because they don't want to pay 2 levels of tax. The other tax system is more of the partnership type called pass-through taxation, where there's no entity level tax, but the owners are taxed directly. Where there could be an issue in the international context is a foreign corporation that has operations in the U.S. I'll speed this up. I just saw the time. That has operations in the U.S. and they operate through a branch, so they don't incorporate a business in the U.S. They would be subject to corporate tax on their income tax rate, but when they distribute out to their shareholders that through the foreign corporation, there's no second level tax. The branch profit tax allows for the second level of tax. This is key. The regulations and through treaties, 28 countries are not subject to the branch profits tax, so they can get that benefit. And so really the key is, as I talked about briefly, is in repatriation planning, you can liquidate, a foreign company can liquidate a C corporation and not face the second level of tax, but you have to terminate the operations. If that company can claim treaty benefits to not be subject to the branch profits tax, then they can just make dividend distributions essentially out from the branch tax-free, and you don't have to worry about liquidating the company to get the tax advantage. Moving to the state taxes. For state taxes, states don't have to follow income tax treaties. So that means in order to incur a state income tax, a permanent establishment is not required, effectively connected income. A certain nexus is required, but states are not bound by US tax treaties with other nations, so that's important. There's some laws that restrict the ability, federal laws of states to impose a tax, an income tax, and so this only affects income tax, and it's only on the sale of tangible property. Recently, there's a big case for sales tax for remote sellers. It's called the Wayfair decision, and that changed what used to be required a physical presence for there to be a sales or income tax, or sorry, really a sales tax, to an economic activity within the state. So now remote sellers who have certain level of sales can be subject to tax, state tax in the US. So the key is you really have to be looking at both the state income tax of the jurisdictions you're dealing with, as well as federal income tax implications. Going to the next slide, just some, in looking at how to structure things, the corporate income tax rate is now a flat 21%. So that makes using a corporate structure more favorable to foreign companies than it used to be. And then the individual tax rate, so pass-throughs, is up to 37%. There's now a 20% qualified business income deduction, so that reduces that individual tax rate to an effective rate of 29.6% if you can meet all the tests. You know, in determining what state or states you might be dealing with, you may want to look at the income tax rates, if there is an income tax, the sales and use tax rates, and other types of tax they might have. And repatriation considerations, again, in liquidating the company, the foreign company can get profits out tax-free. If no branch profits tax is applied, dividends can come under a treaty, dividends can come back tax-free. And then use of interest, or a lot of what Dean was talking about, where the U.S. is keen on, but the transfer pricing, typical arm's length standards. But can you use interest income or other ways to get profits out at preferred rates? And I will stop there.
Thank you very much, Chris. We do have some questions, and so keep the questions coming in. The first question is for Dean. And so Dean, it's kind of a two-parter, maybe kind of two big parts. How do transfer pricing rules differ around the world? And like in terms of things that probably people in North America would need to know and be aware of. And then what general advice do you have for companies on transfer pricing? So two big questions. After you.
Yes, yeah. The Organization of Economic Cooperation Development, they release or they publish transfer pricing guidelines, which all members of the OECD would have contributed to, and Canada has kind of endorsed the OECD transfer pricing guidelines. And the last update, it's continuing being updated, but the last significant update was dealing with the base erosion profit shifting conundrum that the tax authorities were finding themselves into. And they got a lot of developing countries involved in the discussion. So these guidelines are not just only for the OECD members only, but there's a lot of other countries that have contributed and done work on the guidelines. And Canada, and both Canada and the US, they follow these guidelines. Each country probably has nuances in how they interpret the guidelines. One example is the best method analysis versus a hierarchy method. Historically, this has been a big difference between Canada and the US transfer pricing approach, where Canada was very much of, if you have comparable transactions, then you must use that comparable data, make the adjustments that are necessary in order to do it. Whereas the US was saying, well, if that transactional data isn't that good, or the number of adjustments you have to make are too many, then a profit-based method is the best method, and that's the one you should use. Canada has gotten away from the hierarchy method and is more in line with the US thinking and other countries that on the best method, but we still have that history. So you still have to be thinking of the hierarchy of methods while you're justifying which transfer pricing method that you're using. So the good news is that a lot of the countries do follow these guidelines. You just, when your general advice with respect to transfer pricing is when you is a cost benefit analysis. Like a lot of the companies that Trowbridge deals with are the mid-market or the small multinationals that are developing, and often it's more important to get the transfer pricing policy right at the start by looking at the OECD guidelines. What are the methodologies, and what methodology is the most suitable for you, and let your business drive what method you use. Don't let your tax department, or don't let me determine what transfer pricing method you should use, because it really should be in line with how your business operates. So if you have a subsidiary and their scope and responsibility is focused on revenue, they are to maximize revenue, then a transfer pricing policy should be linked to revenues, and so that the incentive and scope is equal. If you have a related party and say they're doing research and development, or they're doing certain types of activities that benefit the group, and they're more of an expense center or a cost center, and they develop something, but they're really told specifically what to develop, then perhaps a high cost plus is appropriate on their budgeted cost. So how the business works is how the transfer pricing methodology should be tied into it. As companies grow and as the transactions become more complicated and as more risks develops, you want to, at that point in time, if you're in different countries, identify the exposure, and again, going back to the cost benefit, where is your highest exposure, and deal with a country expert that deals with that tax authority. I deal with a lot of my clients when we deal with the Canada Revenue Agency. If I have a client and they have a US IRS audit, I become involved in the background, but not the front line, and I will involve someone in the US who deals with the IRS on a frequent basis. So there is the cost benefit analysis that globally we all follow these general principles that's published by the OECD. As the risk increases, that's when you want to become much more, make your investments in the specific countries and to deal with those growing exposures.
Okay, very good. We have about 10 more minutes, and we'll take questions until then. And so a little bit of follow on to your answer there, Dean. You mentioned about working with mid-market and smaller multinational companies. What types of clients do you typically work with? Certain industries? Are they in certain regions? Tell us more about, if there's someone sitting in Bangladesh right now with a certain type of company, would you be a good person to speak with? Tell us a little bit more about that.
Yeah. With Trowbridge, just by the nature of Canada, 2/3 of our clients are kind of the Canada-US entities. So most of my work is done on US-Canada transactions. And the other 1/3 would deal with outside of North America. going back to OECD guidelines, is that we all follow the same type of principles. So yes, I could do work for Bangladesh following these OECD guidelines, but again, you know, what's the, how large are the transactions? Do we want to involve someone that's local to be to develop that expertise? And there you're really looking for expertise of the tax authority and the tax regime with respect to the transfer pricing. As far as industries, because I've been around transfer pricing, you know, over 20 years, I've kind of dealt with all industries, and I rely on my client and the company to know their industry, and I become the expert on the transfer pricing principles and the OECD guidelines. And I said earlier, you really have to let the business drive the transfer pricing. That's what I get from my clients is, okay, you explain to me what's important about your business. And each, you know, there's been, as an example, there's been cases where I've been approached to do a job, and I'm already working for that company's competitor. And in that type of case, then, you know, very transparent, I go back to my existing client, says, I've got this opportunity, you know, we'll put up the Chinese walls, and we can work for both of you, but I need your approval first. And that works when you're very up clear, and you make sure that you don't, that, you know, you keep the confidential information confidential. And if you are a customer going to that first company or the second company, you might not think there's any difference between how they operate and how they deal with. But in actuality, they might be very different. And when you're dealing with a Canadian entity, maybe the one is the Canadian parent and they've developed the IP. The other company might have a US parent, and the US is developing all the IP, and Canada's licensing the IP from the US. Or you just might have more of a service function, customer service function from Canada versus the whole marketing group in Canada. So from a customer perspective, you may not see how the transfer pricing policies are different, or the complexities would be different. So you do all different types of industries, but you're really focusing on what's the scope, responsibility of each of the different entities in the different countries to drive the transfer pricing, and that can be applied to a number of different industries. Certain industries that are more unique that you probably want more expertise on is you know, the banking, the insurance, the financial industry. I've done some work in that industry, but you often want to make sure that who you work with is familiar with those industries. And it's often good to understand what industries people have background in, to that, you know, kind of jump the learning curve, and kind of dealing with the issues very quickly. Often you find that when you talk about a company's critical success factors, you can kind of get to those critical success factors with a discussion, with the interview with the client, you know, probably within an hour call, to understanding the whole business. And it's those critical success factors, who is contributing to each of those critical success factors, which develop your transfer pricing model. And it's, when you do it that approach, it's much more defendable, because it's with the business. When you describe it with your to the tax authorities, it's much more stronger. And the last couple of cases that have come out, both in Canada and the US, has been very detailed on the facts of the business, the circumstances of the business, and how that impacts the transfer pricing. There's some cases where I was wrong, and when I was looking at the background facts on which way it would turn. And when you read the description, it's really driven by the business facts and circumstances that impact the transfer pricing. And when you don't have that upfront knowledge, you may not. That's where some of the problems might develop. So it's really letting the facts and circumstances and how the business organized drive the process.
Very good. Back over to you, Chris. Largely the same question. What types of clients are you working with? It sounds like you're involved with two groups, both the tax group and the private client and wealth preservation group. I think you've talked mainly today about the tax clients, but if you could explain a little bit more about that. And then when is the best time to have a conversation with you?
Yeah, so you're correct. I work with both private wealth and business clients, usually on international matters. I do both inbound companies coming to the U.S. and outbound transactions primarily. So U.S. companies looking to expand abroad. And the best time to come to me is at the beginning when you're setting up, is once you establish a structure. A lot of times it can be hard to change, whether it's a U.S. company going abroad. There's a bunch of rules that just changed through the recent Tax Act, and then if you're coming inbound again, there's a setting up the correct structure ahead of time is important, and a lot of tax is pre-planning in order to make sure that you don't get stuck in structures that are unfavorable, and so I would say as soon as you know that you're looking to the U.S., try to get someone involved, and especially if you're selling kind of intangibles or tangibles from outside the U.S. into the U.S., and you're not sure whether you have enough contacts for there to be any concern about income tax. It's not uncommon, for example, for Amazon maybe to withhold if you sell through Amazon on a sale you made, whereas some other companies who do the same thing that you're selling through don't. Only one of those answers can be correct. And what the U.S. tax authorities do a lot of times is they don't declare each transaction is valid. It typically takes 2 or 3 years for them to catch on, if they ever do, and then they come kind of heavy-handed with penalties if they think you should have been paying tax. So it's really, I would say from the beginning when you really start the process from the inbound side of starting operations into the U.S. And same thing when you're looking to go outbound as well.
Very good. The questions that I see are mostly private, and in the sense of probably they just need to connect up with you. So what I would suggest then for those of you who have the private questions, either connect to them directly, which you can do if you're a member, or send an email to info@globalchamber.org, and we'll make sure that you get connected. So we really want to thank Dean Morris, Senior Transfer Pricing Advisor at Trowbridge, and Chris Klug, who is a partner of the tax group and private and client and wealth preservation group in DC. Really appreciate both of you and your comments and your information. I learned something today when you, Chris, talked about the Chinese, it was Dean, you mentioned Chinese wall, and for some reason that just struck me as odd. But I guess it's a very commonly used word. It's an insurmountable barrier, especially to the passage of information or communication. So maybe it's because I'm mainly been on the marketing and sales side. I'm not sure we've ever used that word, but on the accounting side, it may be more used. I'm not sure. So, but I thank you for sharing that and adding some words to my limited vocabulary. We'll also have a blog post with the recording of this associated with it over sometime in the next week to 10 days. So if you'd like to check out that again, please check that out. And I want to thank everybody. We have starting, I believe, on March 9th, we have we're back into our weekly Globinar series, and so check that out. I know one of the topics is very timely. It's about the USMCA or the new NAFTA, and we have really, I think, the U.S. premier expert on that speaking, Dan Ujo of Dickinson Wright, and so check that out. That's actually May 23rd, and we have events on the 16th to 23rd. And on the 29th, I know the one on the 29th is around Industry 4.0, very timely topic. Thank you, gentlemen. Thank you for all of you for watching, and have a great day.
Thank you.
Thank you.
Take care.